Hey traders, this is Blake Morrow with Trader Summit, and I have Jim Welsh with Macro Tides. He's here to break down the markets as he does every Friday. Now, before I bring Jim in, I can see, and I know everybody else can too. I want to make sure that you guys give him a big thumbs up, subscribe to the channel, but really give him a thumbs up. He comes here every Friday, gives you this exclusive content, really breaks down the market. And you know what? He's actually pretty good. That's why we keep bringing him back. So Jim, welcome back. Good to see you.
It's good to be here, and thanks for the nice words.
Well, you know, it's really, like I said, it's always a pleasure to have you here because you really break down the markets for us and make it easier for us to understand as you put it all together, especially from a macro point of view, and then, you know, morphing it into what it means for actionable ideas in the market. So I love it, and I know a lot of people do too. You're gaining quite a following that's just tunes into you every week. So kudos to you. But we'll talk more about what you do a little bit later. But let's talk about like the markets and what do you make of this jobs report that we got today?
Well, it's everything that the Fed maybe wouldn't want to see. At the same time, it really shouldn't be a surprise. It's going to take a while for the labor market to really unwind the tightness that has built up. If you think about it, you know, companies have been looking and looking and looking to hire people without a lot of success. And what that means, Blake, is at some point in time, even once business slows, there's going to be a built-in reluctance to let people go. You know, you struggled so hard to get employees, you're not going to just do a 180 and let them go.
Yeah.
You're going to cut hours and so forth. So
I mean, you invest a lot of time, effort, and energy as an employee or employer, excuse me, to bring on somebody, teach them the ropes. Then they're intertwined in your ecosystem. It's hard just to cut and run, you know, with people, even down to like the services sector, right?
Absolutely. So the JOLTS survey came out earlier this week, and everybody got all hyped up and excited because the number of job openings dropped from about 11 million to 10 million. Pretty big drop. But again, you can still see the gap from where it is after that decline and where the highs were back in 2018. And those highs in 2018 were significant highs. So in other words, the labor market was quite tight in 2018. So just getting back to that level doesn't necessarily, you know, mean that, oh, okay, all the tightness is gone. The ratio is about 1.7 openings to each one unemployed person. I'd say at a minimum, you know, the Fed wants to see that number get down close to 1. Chair Powell has referenced the extremely tight labor market and has said that, and his hope is that this alone will go a long way to relieving labor market tightness. I don't completely agree with that. I mean, it definitely is going to help as we see more companies cut back on their potential hiring plans. But I think the problem is you have what I would term a chronic labor shortage that has been building up gradually over 20 years based on the labor participation rate. And that was one of the elements that came out this week with the jobs report today, Blake, which in my opinion was more important than the actual jobs number. Labor participation rate actually ticked down. The implication meaning is that the number of people that are on the sidelines ready to jump in and join the labor market did not improve. And so that just reinforces the labor market tightness. So I think, in my opinion, the two numbers that mattered the most was the labor participation in average hourly earnings and wages, which were up about 5%.
But didn't the wages come in a little bit softer? I mean, just a wee bit.
Well, I think they were unchanged from last month, I believe, or maybe down a tenth.
But the year over year it came down.
Year over number maybe down tick from 5.2 to 5. I don't know. I haven't looked up that number, but that's still way above, if you will, what the Fed considers a tolerable inflation rate. That's got to get down under 3%, I think, Blake. Wow. And again, it's a function of labor market tightness, and year over year increases are going to slow as employers don't have to pay bonuses, aren't jacking up wages to attract new employees. All that takes time. It's going to happen. But that's why I think the jobs report, the number of, that labor participation rate was kind of, I think, a key number, and it didn't support the idea that the Fed is on the verge of a pivot. And so you see this outside reaction again.
Obviously, the market didn't like that. Yeah,
not at all.
All right. Well,
okay.
you got the Fed fund futures here. So what are you seeing with this chart?
Okay, so the Fed has continually said, and the dot plots 2 weeks ago showed that the Fed is going to raise the funds rate to a high level, whatever that turns out to be. I believe 4.25-ish, and then hold it there for all of next year. You look at the Fed funds futures, and they have continued to believe that the Fed will start cutting rates in the second quarter of next year. So that may or may not turn out to be true. But in the short run, the Fed is going to continue to push against, and they have rather uniformly in numerous speeches this week come out and say, no, we're going to raise the funds rate, and then we're going to keep it at that high level. So my point is that you still have this expectation in the markets, if you will. The Fed's going to raise up rates into the first quarter of next year, and by the second quarter, they're going to be bringing them down. And the Fed's saying, no, that's not what we're going to do. So I think, again, this just shows that the market is chewing at the bit. Just can't wait for the Fed to signal that they're going to start cutting rates or slow the pace of increases. And the Fed, in the short run, I think, is just adamant in terms of delivering that message.
And you've been very vocal about this, but it's now a growing consensus that the Fed is going to raise rates and just keep rates high for a extended period of time. Now you have been talking about this for a long time, but yes. I think you could see by the just very, very, very slight misses like we saw on the ISM. I think it was the wages component of the ISM services. You can see the market snap right back. So it seems like the market's just clamoring for something that shows that the economy might be slowing. Is that correct?
Yeah, right now, softer news is greeted warmly by the market because it translates into, hey, the Fed's going to stop raising rates. I'm kind of maybe in the minority because I think the percentage based on the Fed funds future, the probability of the Fed going 75 basis point November 2nd is over 70%. And I think some of the dislocations we're seeing, and there's the chart of it, reinforcing that point of it's hard to see the bottom, but you can see they basically go up to 4.25 called, then up to 4.6, and they hold it all the way through the end of next year. So this is the message the Fed has been delivering, and the market just has chosen not to listen to it.
What?
Yeah, just kidding. You did that last week. It's very effective. Can you hear me now? Nope, not yet.
I hear, see, no, speak no evil.
Yeah. So I'm in the camp that kind of thinks that there's the chance that the Fed will only go 50 basis points November 2nd. And the reason being is we are seeing stresses starting to build up in financial markets in terms of the financial conditions have tightened rather significantly. We're seeing a drawdown in liquidity in terms of trading in the Treasury bond market, which is theoretically the most liquid market on the planet. And yet bids and the spreads are starting to widen between bid and offers. So there are some signs, obviously what happened last week with Great Britain. So I think there's the chance that the Fed is not going to change course, but I think it's appropriate at some point in time that they only do 50 basis points because they have raised rates significantly, and the full impact of what they've already done won't be fully felt in the economy for another 3 to 6 months. So Anyway, we'll see what happens in the short run. I think the Fed wants to squeeze every ounce of their forward guidance about we're going to be bringing inflation down because they believe that will bring inflation expectations down. And that's part of the equation. They don't want people to begin to behave in the anticipation that prices are just going to keep going up. So that's why I think it's full court press. But I I would be amazed if there aren't some members on the FOMC who won't publicly make comments at this point in time that maybe going 50 and 75 makes sense. But when they get in that meeting room, I think some of those views will be discussed. The CPI that comes out next week should offer a little help in terms of inflation easing a little bit. But, you know, it's up. They said they're data dependent, and that's the way it is.
Yeah.
So TLT. As you know, I've been looking for a developing low in TLT, and this is from last week, as a matter of fact, this chart. So maybe I made a mistake and sent you last week's chart. So I apologize for that. But when we talked last week, I said, hey, it's possible that that rally from right to the left of the blue 5 was an ABC up for wave 4 of 5. So if you look up to the 108.04, that's wave 4 on a bigger scale. Now we're in wave 5, and I thought 1, 2, 3, 4 up to that high last week for wave 4 of 5. And my expectation was that we would see TLT drop to another lower low for wave 5 of 5, which happened this morning. I've been recommending taking positions in TLT in 33%, 33%, 33%. The average cost on those, and the last third was executed on the opening this morning. I think TLT was down to 100.80, $100.80. The average of the 3 recommendations is 103.07. So next week I'll try to remember to send you the right chart. I had all the labels in on it. But,
I mean, this is good. This is good news as the traditional bond portfolios, the 60-40 portfolios might actually yield something. Pun intended, right?
Yeah, absolutely. Right. So anyway, my point being is we're going to see more signs the economy slowing. Inflation is going to come down over the next 6 months, fairly aggressively early next year. And at some point in time, the Fed is going to cut back from 75 to 50 basis points. All of those, I think, will be supportive of a rally in the Treasury market, which I think at a minimum should bring TLT up to 110, 112. I still think that the 120 target is realistic. That was the high in early August, wave 4 of lesser degree. So to me, the tide is going to turn. It's going to take a little while.
Well, what does that mean for stocks? Because if bonds are going to rally, are they rallying as a risk proxy, or are they rallying because they came down with stocks? Maybe they move up with stocks because yields are coming down, so the stock market's going to like that. I mean, was that a false breakdown that we saw, below 3,600? What do we make of all of this, Jim?
Okay. Well, when we talked last Friday, my expectation, and the S&P was around 3,600. I thought that the S&P would rally above 3737, and I've got the labels there, that the low last Friday was a B wave, A, B, up to above 3737. It actually got to, I think, 38 and change by a little bit. But the way I've got it labeled there, as you can see from the high back in early September, that was a wave 2. Now we're tracing out 1, 2, 3, 4, 5, where I think is wave 3. So there is the expectation is sooner or later 3584 is going to be taken out. The other thing that I'll point out, and this is a 2-hour chart, but it's on the daily chart as well. You had a gap up, obviously, this past Tuesday. We had a gap down today. That looks like an island to me. And islands are pretty rare. And it suggests that things could get pretty ugly in the next handful of days.
Well, come on, Jim. It's not an abandoned baby. That's there you go. We can throw another one out at you. But when I look at island reversals, just for me personally, it's kind of like a head and shoulder pattern. It signals a reversal off of a longer term trend. So hopefully, because this is a downtrend, because we've been in such a good downtrend, it negates that island. And maybe by the end of the day, you don't know, it is Friday and we still got a few hours. maybe the
Yep,
market
yep.
actually comes back.
It's
I'm
possible.
hopeful, Jim. You don't want me to you don't want me to be non-hopeful, right?
Absolutely. No, again, closing that gap would be a plus. I mean,
Yeah.
but again, the pattern itself suggests that we're likely to retest 35.84. I think potentially take it out, and then we'll have another rally. But I don't think the Fed is going to offer the hope that people are expecting, and they're going to continue to push back on that. And at some point in time, that I think you get the throw in the towel, that the Fed is intent on tightening and tightening until we go into a recession. Again, they would prefer not to have a recession, but I think they want to press the anti-inflation rhetoric as strong as they can, right now. And that's what they've been doing.
Well, that's going to mean a stronger dollar, isn't it? I mean, we look at the dollar, and the dollar is still in that uptrend, Jim, but are we at the end of this uptrend or what? What do you think?
I think it may have topped,
okay.
When the dollar got above 114. But as I noted in this past Monday's weekly technical review, you really need to see that trend line from the last couple months just below 110 be taken out. And the low this week was 110.05 on the dollar index.
Yeah.
At the high today, it was 112.39-ish. Well, the dollar dropped from its high to the low about 4.7 points. A 50% retracement is 235, 236. And basically at today's high, the dollar retraced 50%. So we're in a little bit of no man's land from a standpoint that you could see the dollar make one more new high. To your point, if you look at the RSI at the bottom panel, you can see it was over 80 at that recent high. And it was confirming those prices. So it would be classic for the dollar to go up one more time, record a lower RSI value, and that would then, to me, really be like, okay, it's time to go short the dollar.
That would be it. So, maybe the euro trades down to 95 and the sterling down to 107, and we put in a new high in the dollar index, but relative strength is divergent, and that signals that maybe that high is in.
The alternative is, hey, we're beginning a correction. The drop from 114 and change to 110 was either a wave A or a 1. And this rebound, since it's 50%, is a wave 2 or B. There's no way of knowing. But given the inherent strength the dollar has exhibited, one has to respect that there's the potential that one more new high is certainly possible.
All right. Well, tell me something good about gold, because I'm a bit of a gold bug right now, and that's not common for me. But gold looks like it really put in a false breakdown below 1,700. Dips have been bought, Jim, and I'll draw it out for you guys. But I kind of look at it like a bull flag pattern. But how are you seeing everything with gold?
Well, we're on the same page. When we talked last week, gold was comfortably below 1,700. My take was I thought that gold would pop above 1,700. You said, yep, we need a few days above 1,700 closes. I agreed completely. The pattern that I'm showing here is that low that we saw a week or so ago was the bottom of a wave B. And within that context, it implies a rally to 1,800 to 1,820. So as you noted, the flag and all the rest of it, that's supportive of that analysis. And what I've noted on the top, you can see the 382 retracement of the $112 rally from the low to this week's high is 1683. So I'd like to see gold hold above that 1680, 1685 level. So far it has. And that, I think, then opens the door for another push so that the gold can make it up towards that 1800 level. So I still am in that camp, and we'll see.
Well, Jim, as a gold bug, I like it. I can't believe I just said that.
Me either.
but with equities trading so heavy, it's hard to think that gold and is going to be able to rally, and the dollar's peaking just yet. So I guess we're going to have to see inflation data next week. What's your call? Are we having topped or what?
Yeah, I think so. But the problem is going to be potentially, and I wrote about this in the October Macro Tides. And if anybody wants to receive a copy, send an email to jimwelshmacro@gmail.com, is that we're going to see the headline number come down, Blake. But because of the residual increases in shelter inflation, which makes up 132% of the CPI, there's a potential that the core rate will continue to creep higher or not drop as much. So there's the potential for a little bit of a mixed reading. But as we move and start to get the CPI data for the next 3 months, and especially in the first quarter, the takeaway values from a year ago are really, really large. So we're setting up for a fairly significant drop in the CPI between now and March. But next week, I think there's the potential the headline will drop more than the core. And it's a question of what the markets decide to, focus more on.
Right. Okay. Well, Jim, I want to say thank you once again for spending your time with us. You always put it together so easy for us to interpret, and also, give us good actionable ideas every single week. So if you like what you're hearing from Jim, make sure you check him out at Macro Tides. Give him a thumbs up on this on the YouTube video, and subscribe to the channel. Jim, thank you so much for spending your time with us.
Hey, my pleasure, Blake. You have a wonderful weekend.
You do the same. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.